Most beginners bleed their accounts completely dry trying to guess the exact tops and bottoms of a chaotic market. There is an alternative. Instead of predicting the future, we are going to use a reactive, systematic trend-following strategy. By the end of this video, you will have a complete, low-risk plan to execute your first trade. You only need 3 tools for this system. You need a basic charting application, a cryptocurrency market set strictly to a 4-hour time frame, and a standard moving average indicator applied to your chart. By shifting your focus from prediction to reaction, you replace emotional gambling with a rigid, executable mathematical plan. Your first rule is to assess the current price strictly in relation to the moving average line. If the price is below the line, you do not buy. This diagram shows an uptrend's core structure. Notice the distinct stair-step pattern forming higher highs and higher lows. In a live market, we seek these same upward steps interacting with our indicator. See how the long-term moving average slopes upward, supporting the price action. Minor dips along the way are normal and completely expected. It is like stepping down into small ditches while generally hiking up a mountain. Your definitive indicator of success is straightforward. The price must be above an upward-sloping moving average, and it must be printing higher highs. A trend is only valid if it meets these exact visual criteria. If the chart looks messy or moves sideways, the system dictates that you do nothing. Identifying the trend is only the first step. You must suppress the instinct to immediately buy just because the price is moving up. In the left panel, we wait for the price to pull back and establish a momentary ceiling called resistance, marked by the red arrow. Your entry trigger occurs when the price violently breaks above that resistance ceiling, shown by the green line pushing through. Let's look at this mapped out with concrete math. If the resistance ceiling sits just below 30,000, your entry trigger is executed the moment the chart crosses the $30,000 line. Many beginners try to buy during the dip to get a cheaper price. We do not do this. We wait because we need absolute confirmation that the upward momentum has resumed. This breakout provides definitive proof that buyers have regained control of the market. The immediate next step, before the market even ticks again, is placing a hard stop-loss order. The placement rule is non-negotiable. Your stop-loss must go just below the most recent swing low, the absolute bottom of the last pullback. Returning to our model, if your entry is at 30,000 and the last swing low hit 29,200, your exact stop-loss goes strictly at 29,100. The logic behind this placement is purely structural. If the price falls below this specific point, the geometric structure of the uptrend is destroyed, and the trade is invalidated. Once the parameters are set, you enter the psychological phase of the trade. Your job now is to literally do nothing. You must ignore minor market pullbacks. Think of it like planting a tree and leaving it alone to grow. By mathematically defining our worst-case scenario up front, we eliminate the anxiety that causes unseasoned traders to panic sell during routine market noise. This leads to the final operational question: how do you know when the ride is actually over? Looking back at our structural chart, focus on the right side. We trigger our exit when the price drops below the moving average, or when the structure forms a definitively lower high, marked by this red circle. On our example chart, the structure finally breaks down at 34,000. We trigger our exit, securing a clear $4,000 profit move. Notice the reality of the execution. We did not buy at the absolute bottom, nor did we sell at the absolute peak. Chasing exact tops and bottoms is a fool's errand. The true objective of this system is to consistently capture the predictable, fat middle chunk of a market wave. To trade with discipline, you confirm the trend, wait for the breakout, lock in the stop loss, and exit only on a structural break. This entire protocol relies on a single mathematical truth to generate profit. You take small losses, and you capture big wins. This chart illustrates the reality of the strategy. Your stop losses will frequently get hit. But those small, controlled losses are easily absorbed by the massive profit of a single trend winner. Open your charting software right now, pull up a 4-hour crypto chart, ensure the price is above its moving average, and practice mapping out these exact entry and exit points. Professional trading does not require a crystal ball. It simply requires you to execute a flawless protocol for reacting to